On the phone with us is a guy who kind of sadly spelled all this out last time he was with us. I'm talking about Stock Market Cycles editor and publisher Peter Eliades. Peter, very good to have you. He joins us on the phone.
Hi, thanks, Neil. Good to be with you again. There's so much to talk about here. This has been a rather exciting time period in the market, hasn't it?
It really has. That's one way to describe it, Peter. But what you saw some time ago is playing out now. What is it exactly? What were you noticing then that's playing out now?
Well, first of all, kudos to you, Neil, for having someone with a technical background on giving exposure, because there's so few financial stations now say, oh, we don't want to deal with that stuff. That's got nothing to do with the market. And, of course, it has everything to do with the market. So I was with you just over a year ago in November of 2017 telling you about my sign of the bear, which is a simple pattern that just looks at up and down stocks on the New York Stock Exchange. There's a certain pattern that forms, and historically going back almost 100 years, when that pattern forms, and I'm not going to get into the technicals of it because it may be hard for people to understand, but it's simply a churning pattern where a lot of stocks don't go up and a lot don't go down. It's kind of even advanced decline line for almost a full month in the market. And that somehow is a pre-omen of a market that's about to run into trouble. That was in November we spoke, and January, of course, a couple of months later, and that's about the time period I gave the outside. I said anywhere from a few days to a few months out, we should see a major market top. In January of this year, the New York Stock Exchange Composite Index, which measures all the stocks on the New York Exchange, made its all-time high. Now, the Dow and the S&P went on later in the year to make higher highs, but the majority of stocks, the New York Stock Exchange Index, made their highs in January of this year. And so the sign of the bear, as far as I'm concerned, worked out very well again. Now, here's something that happened in the last few days, though, Neil. On Friday of last week, in fact, a couple of days ago, I got a phone call from a friend, Tim Wood, who writes a Cycles News and Views newsletter out of Gulf Shores, Alabama.
Sure.
Tim's a good friend and a real good market analyst, and he said to me, he also specializes in Dow theory. He said to me, we got a primary trend change signal in the market. Now, usually primary trend changes via Dow theory don't come until well after you've seen a market top.
If I can just stop you there, my friend, you're a genius. The Dow theory, of course, is one that looks at the transportation stocks. If they start sort of collapsing, it presages bigger things, but go ahead.
Exactly. There must be the transports and the industrials must confirm each other.
Right.
So what we got, quickly, this is how it takes place, and it's easy to visualize it, although the rules get somewhat complicated. You have a high in the markets, and then you have a decline. You have a secondary rise in the market, and then on the next decline, that in-between decline, the first one, the secondary reaction, is broken by both the industrials and the transports. That's kind of a simplification of the rule, but the first time that happened in 9 years, you could argue, was Friday of last week. So Friday of last week, we got a primary trend change signal via Dow theory. Now, I know you remember the name Richard Russell. Richard, of course, talked about Dow theory for so many years. And it's given some great signals in the past. Some of them have been controversial and not so great. The last signal it gave was on, I believe, November 21st, November 10th, actually, of 2007. That wasn't a bad signal, as you know, Neil.
We should say that has some fundamental reasons. I mean, if the stuff that moves stuff is not doing as well, then maybe we're not moving as much stuff.
Exactly.
Right. So now where do you stand? What does it look like to you now with the Dow down close to 400 points? And again, we're at levels we haven't seen since, I believe, October 2017. I'm talking about the Dow. What do you think now is going to happen?
Okay, there's a strong argument now that confirms my feeling that not only were we going to be in a bear market, but that we are in a bear market. And now we're very oversold, Neil. Now, very oversold doesn't mean you necessarily have to reach a bottom, but my best guess at this point would be that somewhere in the next couple of days we're going to reach a tradable bottom in the market where we're going to see ourselves a decent rally for perhaps a few weeks. And you can expect to see some, perhaps as much as a 50% return between the high that we saw recently and the lows that we see whenever they come up in the next few days. So if we have kind of a 50% retracement of that decline, then I would be on the lookout again for the possibility of a continuation to the downside.
But it would still be a bear market. I mean, and this is common in the adjustment phase of a market. If that's what we're going through now, there you're going to have a pop, and a lot of people get sucked into that. But there are a lot of people who've seen with this market when it has touched or gotten near these type of levels that it's bounced off them for years. You don't see that happening. Of course, we've not had something to this degree for a while in February, but this is a little different. What do you think?
Here's a problem, Neil. The problem for me, even recently, even the past few days, is that there is no capitulation yet. We still have people, I'm sure you're talking to them every day, that say, oh, yeah, this has been a little bit more than I expected, but the fundamentals are great, so don't worry about it. The market's going to come back.
So why is capitulation important to you? Why do you follow that? People who just throw up their hands and say, oh, the hell with it.
Because historically, that's the way market bottoms of any kind of importance are formed. You can't find, especially after an important decline begins, I don't believe you can find any kind of important market bottom without capitulation. You've got to have people say, get me out. I don't care where they are. Get me out. I want to sell.
Right.
We don't have that kind of opinion here. We have people saying, boy, what a great time to buy the dip. Here's a great indicator that we point out. It's called the trading index. TRIN is the symbol for it. Right now it's at 79, Neil. What that means is that in terms of advancing and declining stocks, a lot more money is going into the advancing stocks on a ratio basis than is going into the declining stocks. And that means there's no capitulation. There's no fear yet. So based on that, I would have to say that even now, as oversold as we are and primed for a really strong rally, I don't think we're there yet. I think there's still vulnerability in the market.
Do you think the Federal Reserve follows any of this? We're told they don't focus on the markets. But do you think they do? There are some little secret technicians like you in there following this and worried about this?
Oh, believe me, they follow the markets. But in terms of having their secret little technicians, no. I don't think anyone has their secret little technicians, Neil. You know, it's the old Rodney Dangerfield line, I don't get no respect. Technicians... It's the way technicians feel. We get no respect, Neil. I remember when we did our show back in November of last year, you did about a 15-minute segment after mine that I watched on tape afterwards, and I'm not going to mention any names, but one guy said, oh, forget the technicians. You cannot find a major correction in the market without a huge uptick in oil. Well, that's complete malarkey.
Absolutely.
And another one said, there's no example of a major market decline without some fundamental event triggering it. That's just not true, Neil.
Yeah, you're
That's
right.
why technicians get no respect, because we call these things ahead of time, not all of us and not all the time, but we have the ability to call these things ahead of time based on market internals. And then about 6 months later, after the decline begins, and you'll start to see that this time too.
Absolutely.
You'll start to see people say 3 to 6 months from now, well, no wonder the market came down. Look what's happening with this or with that.
You know, technical research and studying markets is something that should be there. It just should be there. So, Peter, I appreciate your taking the time. You got respect here, young man. So, Rodney Dangerfield, you are not. Although you're just as funny oftentimes. So we'll see what happens. Have a very good holiday, my friend. Peter Eliades on this.